from a $47 billion valuation to bankruptcy. This is the extraordinary collapse of WeWork. Welcome to Finance Code. If you're new here, hit subscribe now. More shocking money stories are coming. In the wake of the 2008 financial crisis, the very concept of work was being redefined. A new generation entered the workforce, disillusioned with corporate rigidity and drawn to the freedom of the gig economy. They sought flexibility, purpose, and community. This fertile ground was the perfect landscape for a new idea to take root, an idea that would blur the lines between work and life, promising not just a desk, but a destination. Enter Adam Neumann, a charismatic Israeli entrepreneur with boundless ambition, and Miguel McKelvey, a pragmatic architect. Their venture, launched in 2010, was WeWork. The business model seemed simple: take out long-term leases on large office buildings, transform them into beautiful, functional and communal work environments, and then sublet them on flexible, short-term contracts to individuals and startups. It was commercial real estate arbitrage, but packaged as something far more revolutionary. WeWork wasn't just selling desks. It was selling an experience, a community, a physical social network. The promise was connection and collaboration. Sleek offices were just the beginning. There were kombucha and craft beer on tap, yoga classes and weekly networking events. Members weren't tenants, they were part of a global tribe, connected by a shared ethos of hustle and innovation, all managed through a slick mobile app that fostered a sense of belonging. This vision of a global community, powered by a charismatic leader, was intoxicating to investors. But one investor would change everything. In 2017, Masayoshi Son, the legendary head of SoftBank's $100 billion vision fund, met with Neumann. Reportedly, Son invested $4.4 billion after a brief tour, telling Neumann that he wasn't being ambitious enough. This wasn't just funding, it was rocket fuel, with a clear directive: grow everywhere, at any cost, and grow they did. Fueled by SoftBank's billions, WeWork engaged in blitzscaling, a strategy of prioritizing speed and market dominance over efficiency and profitability. The company expanded at a dizzying pace, opening hundreds of locations in dozens of countries, often right across the street from each other. The goal was to become the undisputed global leader in flexible workspace before anyone could even compete. This hypergrowth allowed WeWork to craft a powerful narrative. It wasn't a real estate company but a revolutionary tech company. It used terms like space as a service and pointed to its data collection and community app as proof. This story was crucial. While a traditional real estate firm might be valued at 2 to 4 times its annual revenue, WeWork was demanding tech multiples of 20 times or more. By early 2019, this narrative had pushed its private valuation to a staggering $47 billion. At the center of this whirlwind was Adam Neumann. He wasn't just a CEO, he was a prophet, delivering sermons on elevating the world's consciousness at lavish company events. With his flowing hair, unconventional style, and messianic pronouncements, the media and investors alike were captivated. He was hailed as a visionary, the next Steve Jobs, a leader who could bend reality to his will. The myth of WeWork was inseparable from the myth of its founder. In the summer of 2019, the anticipation was electric. WeWork, the private market darling valued at a staggering $47 billion, was finally preparing to go public. Investors, employees, and the media eagerly awaited the release of its S-1 filing, the document that would finally pull back the curtain on this supposed tech revolutionary. But when the filing dropped on August 14th, the world wasn't met with a vision of the future. Instead, it was a financial horror story. The numbers were jaw-dropping, and not in a good way. The document revealed that in 2018, WeWork had lost an astonishing $1.9 billion on just $1.8 billion in revenue. It was literally spending more than $2 for every dollar it earned. To soften the blow, the company had invented its own bizarre metric: community-adjusted EBITDA, which conveniently excluded core costs like marketing, design, and administration. Wall Street wasn't fooled. The creative accounting was immediately ridiculed as a desperate attempt to mask a fundamentally broken business. Digging deeper, the S-1 exposed the catastrophic flaw at the heart of WeWork's model. The company had locked itself into tens of billions of dollars in long-term lease obligations, often for 15 years or more, yet it rented out that same space on incredibly short-term, flexible contracts. This created a terrifying mismatch: long-term, ironclad liabilities against short-term, uncertain income. It was a high-wire act with no safety net. Any economic downturn could send the entire house of cards tumbling down. But the financial black hole was only half the story. The filing also painted a damning portrait of founder Adam Neumann's leadership and a shocking lack of corporate governance. Neumann had taken out hundreds of millions in personal loans from the company, cashing out before any other investor. In a move of staggering audacity, he had personally trademarked the word "we," then charged his own company nearly $6 million for its use. The document also revealed a complex corporate structure designed to give Neumann absolute control, with voting power 20 times that of ordinary shareholders. His private jet and lavish parties were no longer seen as eccentric quirks of a visionary. They were now viewed as symptoms of a corporate culture completely unmoored from fiscal reality. The reaction was swift and brutal. The media, once enamored with Neumann's messianic rhetoric, turned on him. The carefully constructed narrative of a world-changing tech company evaporated overnight, replaced by the stark reality: WeWork was a debt-laden real estate company with a governance crisis, run like a personal fiefdom. By September 2019, the IPO collapsed. Valuation fell to $10 billion. Neumann was ousted. SoftBank staged a $9.5 billion bailout, writing down nearly its entire $10.3 billion investment. Layoffs hit thousands. Just as WeWork was reeling from its failed IPO and the ousting of its founder, the world came to a standstill. The COVID-19 pandemic wasn't just a setback, it was an existential threat. A business model built entirely on bringing people together in shared physical spaces was suddenly rendered obsolete by global lockdowns and work-from-home mandates. Offices emptied overnight. Revenue from memberships evaporated, yet the colossal weight of long-term lease obligations remained, ticking up billions in liabilities with no income to offset them. The company was bleeding cash at an unsustainable rate. For the new CEO, real estate veteran Sandeep Mathrani, it was a trial by fire. He embarked on a brutal, yet necessary, restructuring, terminating or renegotiating hundreds of leases in a desperate attempt to stop the hemorrhaging. But then, a lifeline appeared from the hottest trend on Wall Street: the SPAC. For a company still too damaged for a traditional IPO, a special-purpose acquisition company offered a faster, less scrutinized backdoor to the public markets. In 2021, WeWork announced it would merge with BowX Acquisition Corp., a blank check company led by tech entrepreneur Vivek Ranadive. The deal gave WeWork a valuation of $9 billion. On the one hand, it was a staggering 80% drop from its peak $47 billion valuation. On the other, it was a second chance. The narrative was carefully respun. This was no longer Adam Neumann's cash-burning party. This was WeWork 2.0, a mature, data-driven tech company perfectly positioned to capitalize on the new era of hybrid and flexible work. For a fleeting moment, the comeback story seemed plausible, but the public market is a harsh arbiter of value. Once listed, WeWork's stock began a relentless downward spiral. The SPAC-fueled optimism quickly collided with financial reality. The fundamental flaw in the business model remained unsolved: the dangerous mismatch between its long-term liabilities and its short-term revenue. Losses continued to pile up, quarter after quarter. The dream of profitability was as distant as ever. The broader economic climate turned hostile, rising interest rates made borrowing more expensive, and investors fled from unprofitable growth companies. The era of cheap money that had fueled WeWork's ascent was definitively over. The final vote of no confidence came in May 2023, when turnaround CEO Sandeep Mathrani announced his departure. The captain was abandoning the sinking ship. In November 2023, the inevitable finally happened. WeWork filed for Chapter 11 bankruptcy protection. The official filing laid bare the scale of the disaster, listing liabilities between $10 billion and $50 billion. Its market value, once the envy of Silicon Valley, had collapsed to less than $50 million. A company once valued higher than established giants like Ford and Marriott was now worth a fraction of a single luxury New York City penthouse. The 99.9% evaporation of value marked the definitive end of one of the most dramatic corporate sagas of the modern era. The bankruptcy wasn't just a financial restructuring, it was the final official punctuation mark on a story of ambition, hubris, and the ultimate collision between a fantastical vision and cold, hard reality. WeWork proves one thing: hype isn't value, profits matter more than buzz, and unchecked ego destroys even billion-dollar visions. Subscribe to Finance Code for more deep dives into financial scandals and lessons.